Before we dive into today's content, it's important to note that I am not a financial advisor. The information provided in this video is for educational and entertainment purposes only. All viewers are encouraged to conduct their own research and seek professional financial advice before making any investment decisions. When you buy a stock, you hope that it will go up and then sell it to make a profit. Could you be negative regarding a stock's performance and still make money? Well, you can. Let's kick things off by defining what shorting stocks really means. Short selling is essentially a bet against a stock. Instead of buying low and selling high, as you would in a traditional stock purchase, short sellers aim to profit from a stock's decline. Here's a quick breakdown of the process. First, you borrow shares of a stock from your broker with the expectation that its price will drop. Next, you sell these borrowed shares on the open market. Now, you're in a position to buy back the same number of shares at a lower price. Finally, you return the shares to your broker, pocketing the difference between the sale and repurchase prices as your profit. But be warned, short selling comes with increased risk. Unlike buying a stock where your losses are capped at your initial investment, shorting has unlimited downside potential. If the stock price rises instead of falls, your losses can accumulate quickly. Now that we've covered the basics, let's delve into the mechanics of short selling. How does short selling actually work? One of the first challenges in short selling is finding stocks with potential for decline. In this section, we'll explore various strategies and tools to identify stocks that might be ripe for shorting. Keep an eye on overvalued stocks with high price-to-earnings ratios or those facing negative news catalysts. These can be signs that a stock is overhyped and may be due for a correction. Technical analysis is also crucial in shorting. Look for stocks with weakening trends, approaching key resistance levels, or exhibiting bearish chart patterns. Combining fundamental and technical analysis can strengthen your shorting strategy. Another valuable tool is short interest data. This information shows the percentage of a stock's float that is currently being shorted. High short interest may indicate widespread skepticism about the stock's future performance. Remember, thorough research is key. Stay informed about industry trends, company financials, and upcoming events that could impact the stock's value. Now that you've identified a potential candidate, let's walk through the steps of executing a short sale. Begin by checking with your broker to confirm that the stock you want to short is available for borrowing. Not all stocks are shortable, and availability can change frequently. Once confirmed, place a sell order for the borrowed shares at the current market price. This initiates your short position. Keep in mind that your broker may require you to meet specific margin requirements to enter a short sale. Monitor your position regularly, as short selling can be more hands-on than buying stocks. Set stop-loss orders to manage potential losses and be ready to act quickly if the stock moves against your position. Lastly, know the rules for short selling in different markets. Some stock exchanges have specific regulations, such as the uptick rule, to prevent excessive downward pressure on a stock's price. Now, let's discuss the risks and challenges associated with shorting stocks. Short selling is not for the faint of heart, and understanding these risks is crucial to avoid significant losses. The unlimited potential for losses is one of the most significant risks of short selling. Unlike buying a stock, where the most you can lose is your initial investment, short sellers can face significant losses if a stock price continues to rise. Short squeezes are another challenge. This occurs when a heavily shorted stock experiences a sudden price increase, leading short sellers to rush to cover their positions. The buying pressure further drives up the stock's price, creating a squeeze. Dividend payments can pose additional risks for short sellers. If you short a stock just before the ex-dividend date, you may be required to pay the dividend to the lender of the shares, adding to your losses. Despite these challenges, skilled short sellers can thrive by carefully managing their positions, staying disciplined, and conducting thorough research.